Hello and welcome. My name is Julianne, and in this lesson we look at DuPont Analysis, one of the best-known tools in financial statement analysis. Instead of treating a company's return as a single percentage, it breaks that return down into the drivers behind it. At the top sits return on equity, usually shortened to ROE. It tells the owners how much the business earns on the capital they have put in, but a single number never tells you why. 3 companies can all report 20% and get there in completely different ways. One through high margins, another through assets that turn over quickly, a third simply by borrowing more. DuPont Analysis separates those effects. Throughout this lesson, we work with one example, our fictional trucking company, Nordwind Logistics. Before we calculate anything, let's be clear about what this tool does and what it does not do. What it does, it splits a reported return into 3 elements: the net profit margin, the efficiency of the assets, and financial leverage. That lets you compare periods, compare companies, and trace where a change came from. It also helps you ask the right questions. If the return falls, you can ask whether it was the margin, asset turnover, or financing. What it does not do, it rests entirely on reported figures and looks backward. It says nothing about service quality or customer relationships. A company can post excellent ratios and still be losing its market. It also says nothing about liquidity. A profitable company can still run out of cash. So treat it as a diagnostic tool, not a verdict. This is the formula at the heart of the method. Return on equity equals the net profit margin multiplied by total asset turnover multiplied by the equity multiplier. Written as fractions, the structure becomes visible. Net income divided by sales times sales divided by total assets times total assets divided by equity. Look at the middle. Sales appears once in a denominator and once in a numerator. It cancels out. Total assets does exactly the same. What remains is net income divided by equity, the very return we started with. That is the elegance of the model. Mathematically, nothing changes, but 3 separate business questions become visible. Let's take the drivers one at a time. The first is the net profit margin. It answers one question. What share of every dollar of sales is left as profit after all costs, interest, and taxes? The formula is net income divided by sales. Nordwind Logistics books $15 million in sales a year and reports $750,000 in net income. 750,000 divided by 15 million gives a margin of 5%. In practical terms, out of every $100 of sales, $5 remain as profit. The margin reflects the effect of pricing and costs. It improves when prices hold, when the customer mix shifts toward more profitable work, or when costs come down. The second driver is total asset turnover. Where the margin relates profit to sales, turnover relates sales to the assets on the balance sheet. It answers a different question. How hard are the company's assets working? The formula is sales divided by total assets. Nordwind's $15 million in sales come from $10 million in total assets. 15 divided by 10 gives 1.5. A useful way to read that. Nordwind generates $1.50 in sales for every dollar tied up in assets. In a trucking business, those assets are very concrete: vehicles, warehouse space, equipment, and outstanding receivables. Anything that reduces idle capacity or surplus assets improves this ratio. For example, shortening collection periods and using the freed up cash to pay down debt. Now let's combine the first 2 drivers. A margin of 5% multiplied by a turnover of 1.5 gives 7.5%. This intermediate result has its own name, return on assets, or ROA. It relates the company's net income to its total assets. At this point in the breakdown, we have combined profitability on sales with asset efficiency. We have not yet applied the equity multiplier. We can verify it directly. $750,000 divided by 10 million in assets also gives 7.5%. Both routes agree. One technical note: sales arise across the whole year, while the balance sheet is a snapshot on a single date. That is why financial analysis often works with average total assets and average equity. For our simplified example, we stay with the closing figures. So Nordwind earns 7.5% on its assets. Is that good? Before judging, it helps to know what that figure means in money. With $10 million in assets, 1% would be $100,000 of net income. 7.5% is $750,000. 15% would be $1.5 million. At 0%, the assets return nothing, and below zero, the company is making a loss. The direction of reading is clear. All else equal, a higher return means more profit from the same asset base, but that does not hold for every ratio. Collection periods and claims rates are better when they are low. Whether 7.5 is a good number depends on the minimum return the company requires, which accounts for inflation, for risk, and for what the capital would earn elsewhere. Add the trend across several years and a comparison with similar businesses. For our example, this is a solid result. If management wants to improve return on assets, the formula points to exactly two operational routes. The first is to raise the margin. Suppose net income rises from $750,000 to $900,000, with sales unchanged. The margin goes to 6%, and 6 times 1.5 gives 9%. The second is to use the assets better. Suppose Nordwind cuts total assets from $10 million to $7.5 million by selling underused vehicles or space, or by collecting from customers faster. Sales stay at 15 million, so turnover rises from 1.5 to 2. 5% times 2 gives 10%. That improvement requires no additional profit at all. In capital-intensive sectors such as logistics, it can be a particularly important lever. That is the value of the model. It turns the phrase "we need better results" into two separate management questions. The model is usually drawn as a pyramid, and that image is worth remembering. Return on equity sits at the top. Below it, the three drivers branch out, and each one splits further: net income into revenues and costs, total assets into non-current and current assets. That is where the analytical value lies. You can follow a deviation downwards, level by level, until you reach a cause you can act on. An example: Nordwind's return on assets falls from 7.5 to 6%. The margin has held steady, and so the cause is not in costs, it is in the assets. One level down shows that receivables have risen sharply. Customers are paying later. That is no longer an abstract ratio. It is a concrete cause the company can act on. Before we add the third driver, a few words on three abbreviations that are easy to confuse. ROI, return on investment, is the broadest term. It is a general expression, and what counts as the investment depends on context: a project, a division, or the whole company. ROA, return on assets, is net income divided by total assets. That is our 7.5%. ROE, return on equity, is net income divided by equity. That is the figure DuPont Analysis breaks down. The rule is simple. Whenever someone quotes a return, ask what sits in the numerator and what sits in the denominator. Two analyses using the same word can measure very different things. A related question comes up again and again. Which profit figure belongs in the formula? For classic DuPont analysis, the answer is net income, after interest and taxes. That is what makes the equation reduce cleanly to net income over equity. Other models use different measures, for example, operating income or EBIT earnings. Before interest and taxes, those can be useful for judging performance before certain financing effects, but they are not interchangeable with net income in the three-factor equation. What distorts the analysis is mixing those measures. Using net income this year and operating income last year makes the comparison inconsistent. So choose one profit measure, keep it throughout the analysis, and state which one it is. Now to the third driver, the one that turns return on assets into return on equity. It is called the equity multiplier, and the formula is total assets divided by equity. Nordwind's $10 million in assets are financed with $2.5 million in equity. 10 divided by 2.5 gives a multiplier of 4. 7.5% multiplied by 4 therefore gives a return on equity of 30%. The cross-check works as before. 750,000 divided by 2.5 million gives 30%. The multiplier shows how large the assets are relative to equity and so reflects the company's financial leverage. The picture is this. Nordwind has a return on assets of 7.5%, and applying a multiplier of 4 leads to a return on equity of 30%. That last sentence needs a warning because this is where the model is most often misread. Looking only at the formula, it would seem that a higher multiplier always produces a higher return. You would simply need to borrow more. That reading is wrong. Replacing equity with debt does not leave the rest untouched. More debt means higher interest costs, so lower net income, and a lower margin. The two effects pull in opposite directions. Whether leverage works in your favor depends on comparing the return generated before interest costs with the cost of that debt. If borrowing becomes too expensive, leverage can reduce return on equity and magnify the downside risk. And there is a consequence no ratio shows. Interest is a contractual obligation and has to be paid whether business is good or bad. The upside grows, but so does the risk. So, a high ROE is not automatically the sign of a solid company. Always check which driver produced it. Let's put the ratios side by side. The net profit margin, net income over sales, shows what is left from every dollar invoiced. For Nordwind, 5%. Total asset turnover, sales over total assets, shows how hard the assets are working. 1.5. Return on assets, the first two combined, relates net income to the assets. For Nordwind, 7.5%. The equity multiplier, total assets over equity, shows how the assets are financed. 4. And return on equity, the product of all three, shows what the owners earn on their capital, 30%. 5 numbers, one coherent system. And each of them points back to a decision someone in the business actually makes. Let's close with 4 points worth remembering. First, fix your profit measure before you start. Use the same one throughout the analysis and say which one it is. Second, when a return changes, work through the drivers in order. Was it the margin, asset efficiency, or financing? Each one leads to different actions. Third, keep return on investment, return on assets, and return on equity clearly apart. They answer different questions and are not interchangeable. And fourth, read a high ROE with caution. If it comes from strong operating performance, that is excellent news. If it comes mainly from leverage, it carries greater risk. Thank you for watching. If this kind of practical knowledge helps you in your studies, your training, or your work, please subscribe to the channel. We publish new lessons regularly on management, logistics, and international trade. A lesson from QLog Learn Median. See you next time.